Saving for retirement isn't just about numbers. It's about the kind of lifestyle you'll enjoy in future. That's why the changes the government has announced to salary sacrifice rules on pensions matter. For some, they could slightly reduce the tax benefits you enjoyed until now. But the good news is that salary sacrifice is still one of the smartest ways to boost your pension. Also, the changes won't come in until 2029, giving you the chance to plan ahead. In this video, we'll break down what's changed, what it means for your retirement, and how you can still make the most of this valuable benefit. So first things first, what is salary sacrifice? Well, it's an agreement between you and your employer where you give up part of your cash pay in exchange for a non-cash benefit. Instead of receiving that money as taxable pay, your employer directs it into something else, quite often into a workplace pension, but sometimes other benefits such as car leasing or the Cycle to Work scheme. Because your taxable income is lower, you pay less income tax and national insurance, NI. Your employer also saves NI, and some employers pass those savings back into your pension. Many high earners use salary sacrifice to bring their income below certain cliff edges at which they lose valuable tax allowances. For example, they might try to bring their income below the £100,000 threshold at which they start to lose their personal allowance, or below the £80,000 threshold at which they lose all child benefits. But things are changing. The government has announced that as of April 2029, it is capping the maximum amount of your salary you can sacrifice, specifically into pensions, without incurring NI, to £2,000 per year. Any pension contributions above that cap will, from 2029, incur both employee and employer national insurance contributions. So what will this mean for your pension? Well, for some people, it won't change a thing. If you earn £40,000 and pay 5% of your salary into your pension via salary sacrifice, that works out to £2,000 a year. In this case, you haven't exceeded the cap, and neither you nor your employer will be paying any more NI. However, those putting more than £2,000 into their pension via salary sacrifice will have an extra tax bill. For example, if you're earning £40,000 and putting 10% of that into a pension via salary sacrifice, that works out to £4,000 per year. That means £2,000 of your contribution is over the cap and will be subject to NI in future. National insurance for employees is 8% on earnings between £12,570 and £50,270,000. So 8% of £2,000 would mean an extra NI bill for the employee of £160. It'll also impact higher earners. If you're earning £110,000 a year and want to bring that down to £100,000 to restore your personal allowance, you could sacrifice £10,000 or just under 10% of your salary and put it into your pension. Under current rules, there will be no NI to pay on that £10,000. However, under the new £2,000 cap, you'll be paying NI on £8,000 of that money. The NI rate for employees on earnings over £50,270 is 2%. That would also mean an extra NI bill of £160. The change does make salary sacrifice slightly less attractive. But remember, you're still benefiting from income tax relief, which means this continues to be a really efficient way of putting your salary to work. And for those facing income cliff edges, it's still a great way of bringing yourself below those thresholds. It's also worth remembering that not all employers offer salary sacrifice as an option. Even when they do, some people choose not to make use of it because reducing your salary on paper can have other implications. For example, you might not be able to borrow as much via a mortgage. So what should you do now? Well, this is a good opportunity to check whether you're at or over any of those key cliff edges at which you lose valuable tax allowances and benefits. If you are, think about whether you want to use salary sacrifice to reduce your pay and restore those benefits. If you're a high earner, you might want to consider making the most of salary sacrifice before the changes come in by paying a lump sum into your pension or by increasing your contributions in the meantime. So to sum up, don't panic. These changes won't impact everyone, and for lots of people, the impact should be minimal. Bear in mind that your employer will contact you to inform you of any changes. And remember, this change won't come in until 2029. You have time to plan. Pension salary sacrifice is still one of the most tax-efficient ways to save for retirement, especially if you're strategic about it. If you found any of this useful or would like more information on saving for retirement, please subscribe to the channel and join in the conversation in the comments below. And thanks for watching.